This is the Portland Business Journal Thought Leadership Podcast, sponsored by Moss Adams, featuring top professionals and providing insight to keep you and your business informed. In this episode, CPA and Moss Adams partner in tax services, Ryan Kenzi, discusses tax reform and the impact on businesses. Ryan, thanks for joining us. What are the 3 to 5 most important elements of the tax reform bill that could have an effect on businesses?
Thank you, Brian. Good to join you today. First off, really the big news, if you look at tax reform, is that businesses across virtually all spectrums, all industries, are likely going to see a fairly significant rate drop. For C corporations in particular, that rate will go from a top rate of 35% to 21%, which is a 14% drop in marginal rate. And then also, too, for the flow-through businesses, so think about your S corporations, your LLCs, your partnerships, they'll also see a fairly significant rate drop. Right now, the current top rate for flow-through businesses is the individual rate, which is 39.6%. That will drop after the implementation of a new deduction for flow-through businesses. That rate will drop to an effective rate of about 29.6%. Now, a critical thing to keep in mind is flow-through businesses will still get the benefit of a graduated rate system. So they'll start at a bottom rate of 10% and then work their way up. Whereas C corporations will be taxed at a flat 21% for every dollar of income. So there's no graduation for them. That being said, it's still a fairly significant benefit to a C corporation over the past tax law. The other thing to keep in mind, too, for C corporations is that Congress repealed the alternative minimum tax structure, which is a big deal for a lot of folks that have a business structured that way. Secondarily, another big change for businesses is really around the area of depreciation and the benefits provided thereby. Congress changed the bonus depreciation rules, which they've been quite frequent in doing this over the past decade, but they've made them even more favorable than in the past. Bonus depreciation now is at 100% for qualified property, and this includes both new equipment, new property, as well as first-time use property. So it doesn't have to meet that brand new, right off the dealership lot, brand new purchased equipment status any longer. The other thing, too, that Congress provided was a increase in the Section 179 expensing limits. That moved from $500,000 to $1 million. Third item that Congress really did that genuinely helped to provide some simplification to businesses is for businesses that have less than $25 million in gross receipts. They allowed for a number of simplified methods of tax accounting. One, those entities can move to cash method of accounting if they qualify. Two, they can avoid kind of the messiness, if you will, of some of the uniform capitalization rules under 263A of the code. Third, they also get some simplified inventory accounting methods. So really some good simplification there. And then finally, with that simplification, contractors under 25 million of gross receipts can also follow a completed contract method rather than the percentage of completion method. Another big win for them. Finally, as you might suspect, Congress did include some revenue raisers in the bill. It wasn't all good news, so to speak, but the revenue raisers really probably won't impact every taxpayer. One that comes to mind is they implemented a new interest expense deduction limitation. There's a method for calculating that where it's limited to 30% of your tax EBITDA for simplistic purposes. The other thing, too, is that business entertainment expenses are no longer deductible. If you recall, under the old law, they were deductible to the extent they qualified at 50% of their cost. Now they're no longer deductible. Finally, another example where there was a revenue raiser was for those that have foreign subsidiaries. And these foreign subsidiaries will be facing a transition tax amongst other taxes here in the future. But the transition tax is, in essence, a tax on the deemed repatriation of their foreign profits. So likely to be a fairly significant revenue raiser for the federal government.
Okay, Ryan, it sounds like we can't write off those Blazer tickets anymore.
You are exactly right in that. Those Blazer tickets, you can't write them off. And there's also some changes in the deduction around contributions to colleges and universities for your sporting tickets there as well.
Okay, Ryan Kenzi joining us. He is a CPA at Moss Adams, partner in tax services, breaking down tax reform. We've got a handle on the business side of it now. Let's shift gears and talk about the personal, the individual side, maybe the top 3 to 5 most important elements for individuals.
Certainly. As I mentioned previously, rates are coming down for businesses. The same is true for individuals broadly across the board, whether you're filing as an individual, filing married, filing joint. For all the filing statuses, rates are coming down. The old top rate of 39.6% is now 37%. And also, too, Congress reconfigured the brackets where it takes more income to get into the high rates. Another big thing, especially for states like Oregon, where we have a state income tax, the federal government previously provided for a deduction for state income taxes paid. That deduction is now being limited, and this is limited for state income taxes, state sales taxes, and property taxes to a total of $10,000 for a married filing joint taxpayer. It's $5,000 for a single taxpayer. So a fairly significant haircut, if you will, on the deduction, especially for high-income earners. Now, there's a nuance to it. If that individual or that married couple was in the alternative minimum tax structure, likely they weren't getting a whole lot of benefit out of that state deduction as it was. That being said, we do work for a lot of individuals that were out of AMT, and that deduction was significant. Next thing, too, a significant change is the alternative minimum tax structure was retained on the part of Congress. And so while I would have liked to have seen the AMT go away, they kept it, but they made some significant tweaks to it. One, they raised the exemption amount, and two, for that exemption, you don't begin to phase out of it until you're for $1 million of adjusted gross income for a married filing joint filer and $500,000 for a single filer. So our initial read of the bill is that many of the taxpayers that previously were in AMT are no longer going to be in AMT. So a fairly significant benefit to them. Another thing, too, for those that are looking at their estate planning, the lifetime exemption amount was raised from $5 million per person to $10 million per person, and then indexed to inflation. So for those that are doing estate planning and planning to transition wealth over the next 4 or 5 years, we see this as a significant window of opportunity for those that would be doing that type of planning at the moment. Lastly, one of the things that Congress was batting back and forth for a while was what to do with the home mortgage interest deduction. That benefit was retained, but it was reduced slightly. In the past, you could have $1 million of qualified indebtedness, and you could deduct the interest on that. Now they've reduced it to $750,000. So number of significant changes on the individual front. None of them are great sweeping changes on their own, but when you start to add them all together, they can be very meaningful.
You're listening to the Portland Business Journal Thought Leadership Podcast, sponsored by Moss Adams. In this episode, we have CPA and Moss Adams partner in tax services, Ryan Kinsey, joining us to talk about tax reform. You know, Ryan, the tax reform bill was really pushed through pretty quickly. Any items in the bill that you think will need maybe further clarification or even correction?
Certainly. With any bill like this, even bills that go through Congress at a more measured pace, there's always clarification that's needed to help to explain what the legislative intent of Congress was. In this case, given the process, and I believe it took 13 days from the initial writing to the passing of the bill, there will be a significant clarification that will need to be provided. Number of examples of that is really in the area of what exactly a qualified business is for purposes of this new flow-through deduction of 20%. What businesses genuinely qualify? What activities don't qualify? Will they allow for a grouping of entities that are in an economic unit? The questions really are there around that topic, and we're looking forward to some guidance from the Department of Treasury in the regulation writing. Another area, too, where there's some ambiguity is in the definition of what exactly qualified property is for purposes of the new 100% bonus depreciation. It's fairly clear from their legislative record that equipment would qualify. But what about other improvements as to leasehold improvements or things of that nature where it's improvements to a building rather than manufacturing equipment, as an example? Lastly, and this isn't for the faint of heart, for those that started digging into the international provisions of the new tax law, there is a significant amount of change as to how the U.S. views businesses that operate abroad. There, too, the more you read, the more you can find little things that raise questions as to the application of the new law. There's a lot of disclosure requirements, both in the old law and the new law. How will those disclosure requirements be reported to the IRS? What all information will be necessary as part of that process? My advice to any taxpayer is stay in close contact with your tax advisor over the next 18 months. There's a lot that we're all going to be learning over that period of time, and there's a lot to be discussing. Just by the fact that we don't know exactly how the new tax law will be implemented doesn't mean that we should stop from our planning. We should all be looking at how we can best position ourselves and our businesses to succeed into the future.
Ryan Kenzi is joining us. He is a partner at Moss Adams in tax services. And, it's interesting. The Oregon legislature is currently in session. Do you anticipate the Oregon legislature making any changes to Oregon's tax law as a result of what we've seen at the federal level?
Absolutely. So as everyone's likely aware, the Oregon legislature is in a short session. They began in early February, and they expect to complete this session, I believe, in early March. With that, one of the top items on their agenda is tax reform at the federal level and what they will do from a state perspective. Typically in the past, and this has been the case for about the last 6 years, Oregon has applied what they call a rolling reconnect, where they adopt all the tax provisions of the federal tax code. It makes it easier for the state of Oregon to follow and to implement its own policy. That being said, the legislature has been fairly clear here over the last number of weeks that they don't intend to do that in totality. Some of the things that are on the table for discussion, nothing's final, but what we're seeing come out of the legislature at the moment is, one, there was strong support in the legislature to make a change to the Oregon tax law, whereby the international transition taxes that would apply at the federal level will also be taxable income in Oregon. Another thing, too, that we're seeing that the legislature is batting around is the concept of this deduction for qualified businesses that are flow-through businesses, that 20% deduction. Early indication appears that they may not adopt that standard for Oregon purposes, but yet that those provisions are still being debated in the legislature at the moment. Also, too, it's interesting that in the past, Oregon has disconnected from some of the federal bonus depreciation rules. It appears at the moment that Oregon will be adopting whatever the bonus rules are for federal. Oregon will follow suit. Time will tell whether they stick with that. And then lastly, for any taxpayers that use an IC disc in the state of Oregon, you likely recall that there is a favorable tax rate for an IC disc at 2.5% for the tax rate rather than the full 9.9% paid to the state of Oregon. It looks like that favorable rate is intact, but time will tell. As we all know, a lot can happen in a couple of weeks' time. And so we will all sit and watch here as the legislature works through the process of making their decision as to whether they connect fully to the federal law or make significant modifications from it.
You're listening to the Portland Business Journal Thought Leadership Podcast, sponsored by Moss Adams. In this episode, CPA and Moss Adams partner in tax services, Ryan Kenzi, joining us. Ryan, we have one last question for you here. Back to business owners and executives. What do you see as the critical action steps for these business owners and executives here in 2018 and forward?
Yes, certainly there's a lot of opportunity here. While we may not fully agree with all the provisions of the bill, and they may not impact us uniformly as taxpayers, that certainly doesn't mean we should just sit back and let tax law happen to us, so to speak. This is certainly another opportunity provided to all of us as taxpayers to assess our businesses, to look and make sure that we're in the right entity structure, that we're making the right methods and decisions from a income standpoint. As I mentioned earlier, there's a lot of changes as to tax methods for smaller taxpayers. Certainly those should be evaluated. And generically speaking, whenever there's a shift in tax rates, and in this case, we're going from a higher rate to a lower rate, taxpayers should be looking at what they can do to accelerate deductions into 2017 and defer income into 2018 and beyond. So a number of things to do there. The main thing that I'd want to leave everybody with is be proactive. Get in front of your tax advisors, whether that's your CPA or your attorney or both, and just make sure that you're doing a good job with your planning in this year and not letting the opportunities that are there drive past you.
Ryan Kenzi at Moss Adams, thanks for joining us.
Gladly. Appreciate the opportunity and thank you for allowing me to talk about tax reform today.
You're listening to the Portland Business Journal Thought Leadership Podcast, sponsored by Moss Adams. For more downloads, visit our podcast hub.